Did you know that 78% of Americans live paycheck to paycheck, struggling to build wealth? This isn't by accident. There's a hidden system designed to keep you trapped in a cycle of earning and spending. But what if you could break free? This system isn't a conspiracy, but a consequence of our economic design. For decades, inflation has eroded purchasing power, silently stealing your savings. A dollar today buys significantly less than it did 20 years ago. Are you feeling its bite? Compounding the problem is financial illiteracy. Only 57% of American adults are considered financially literate. This knowledge gap prevents millions from making informed decisions, leading to missed opportunities and mounting debt. Ignorance truly is expensive. This lack of knowledge often leads to the rat race, working solely for a paycheck, only to see it disappear into bills and fleeting pleasures. You're trading precious time for money, but not building lasting assets. Isn't it time to change that equation? Many believe a stable job is the ultimate security. While essential, it often creates an illusion of wealth. You're dependent on one income source, vulnerable to layoffs or industry shifts. True wealth comes from diverse income streams, not just a single salary. One of the most powerful forces in finance, yet often ignored, is compound interest. Albert Einstein reportedly called it the eighth wonder of the world. Investing just $100 per month at a 7% annual return for 30 years could grow to over $120,000. That's financial magic! The cost of inaction is immense. If you'd invested just $1,000 into an S&P 500 index fund 10 years ago, that investment would be worth over $3,800 today, thanks to an average annual return of 14.7%. Delaying your investment means delaying your freedom. Behavioral biases like FOMO, fear of missing out, often derail even the best intentions. Seeing others profit from meme stocks or crypto pumps can lead to impulsive, high-risk decisions. Remember, true wealth is built patiently, not through chasing fleeting trends. Then there's lifestyle inflation. As your income rises, so do your expenses. That new car, bigger house, or luxury vacation feels earned, but it traps more of your future earnings. Break this cycle by investing the raise, not spending it. The secret to breaking free is building passive income streams. Imagine money flowing into your accounts even when you're not working. This could be from real estate, dividends from stocks, or even a successful online business. It's about making your money work for you. The power of time in the market is often underestimated. A 25-year-old investing $500 monthly could accumulate $1.8 million by age 65. Waiting until 35 cuts that by nearly half. Your biggest asset isn't money, it's time. Don't waste it. Diversification isn't just a buzzword. It's your shield against market volatility. Don't put all your eggs in one basket. Spreading investments across different asset classes, stocks, bonds, real estate mitigates risk and smooths out returns. Protect your portfolio. The fundamental shift you need to make is from being an earner to an owner. Instead of just exchanging your labor for money, acquire assets that generate income independently. This is how the wealthy truly build and preserve generational wealth. Start owning your future. Your first concrete step is to create a personalized financial plan. Understand your income, expenses, and long-term goals. Whether it's early retirement or buying a home, a clear roadmap is essential. Don't just wish for wealth, plan for it. The system that keeps many poor thrives on financial ignorance and inaction. But you now have the knowledge to break free. Take control of your money, invest wisely, and build your own path to financial independence. Your future self will thank you for it. While you build your financial plan, inflation silently erodes your wealth. Holding cash today means losing purchasing power tomorrow. With 2023 inflation at 3.1%, your savings are literally shrinking. Another silent wealth killer is high-interest consumer debt. The average credit card APR in the US hit 21.47% in Q4 2023. This isn't just spending, it's a debt trap that costs you thousands annually. Even when you invest, high-fee mutual funds can sabotage your returns. Many active funds charge 1–2% annually, yet 85% of large-cap funds underperformed the S&P 500 over 10 years by 2022. The antidote: low-cost index funds, or ETFs. The S&P 500 has averaged about 10% annual returns over the last century. You capture market growth without active management fees eating your profits. This leads us to the eighth wonder of the world: compounding. If you invested $10,000 at age 25 with 7% annual returns, it could grow to over $130,000 by age 65. without adding another dime. To supercharge compounding, leverage tax-advantaged accounts like your 401k. Many employers offer a matching contribution, essentially free money, boosting your retirement by 50–100% instantly. Don't stop at the 401k. Consider a Roth IRA, where your contributions are after tax, but withdrawals in retirement are completely tax-free. This offers incredible flexibility for future tax planning. A common mistake that keeps people poor is trying to time the market. Studies show missing just the 10 best days in the S&P 500 over 20 years can cut your returns by more than half. Instead, embrace dollar-cost averaging. Invest a fixed amount regularly, whether the market is up or down. This strategy reduces risk and ensures you buy more shares when prices are lower. Diversification isn't just a buzzword, it's a critical shield. Don't put all your eggs in one basket. Spreading investments across different asset classes like stocks, bonds, and real estate reduces overall risk. Your risk tolerance is unique. A young tech worker with 30 years to retirement can stomach more volatility than someone nearing retirement. Align your investments with your personal comfort level and time horizon. Before aggressive investing, build an emergency fund. Aim for 3–6 months of living expenses in a high-yield savings account. This acts as your financial shield, preventing debt when unexpected costs arise. Breaking free means cultivating a generational wealth mindset. It's not just about paying your bills. It's about building a legacy, ensuring your children and grandchildren have a financial head start. This shift from merely an employee to an active investor is monumental. You're no longer just exchanging time for money, you're putting your money to work for you, creating true financial leverage. Your immediate next action: review your current investment portfolio. Are you paying high fees? Are you diversified? Are you maximizing your 401k and Roth IRA? Take control, starting today. Beyond stocks and bonds, smart money diversifies. Consider alternative assets like real estate, private equity, or even commodities. These can offer uncorrelated returns, hedging against market volatility, and expanding your wealth potential. Many still cling to safe investments like low-yield savings accounts or CDs, unaware that inflation silently erodes their purchasing power. With 2–3% inflation, your money is losing value every single day, year after year. The true cost of inaction is staggering. Over the last 50 years, the S&P 500 has averaged over 10% annual returns. Delaying investment even a few years can mean hundreds of thousands, if not millions, in lost compounding potential. We often fall prey to anchoring bias, fixating on past prices, like that tech stock you bought at its peak. This prevents us from making rational decisions based on current fundamentals and future potential, keeping us stuck. FOMO, the fear of missing out, drives irrational decisions, especially during tech bubbles. Remember the dot-com bust or recent meme stock frenzies. Chasing fleeting gains often leads to significant losses. Patience is your ultimate edge. To counter market volatility, embrace dollar-cost averaging. Investing a fixed amount regularly, regardless of market highs or lows, means you buy more shares when prices are down and fewer when they're up. It smooths out your returns over time. Tax efficiency is paramount for long-term wealth. Maximize your 401k and Roth IRA contributions. Understand capital gains taxes and tax loss harvesting. These strategies can save you thousands annually, accelerating your path to financial freedom. Revisiting fees. Beware of the hidden costs in actively managed mutual funds. Their average expense ratio often exceeds 1%, significantly eating into your returns over decades. Low-cost ETFs, with ratios under 0.1%, offer superior long-term performance. The allure of day trading is powerful, promising quick riches. Yet, studies show over 80% of day traders lose money, with many blowing up their accounts. This isn't investing, it's high-stakes gambling, a system designed to extract wealth from the impatient. True diversification means looking beyond your domestic market. Global exposure to international stocks, emerging markets, and even real assets like gold or timber can cushion your portfolio during regional downturns and capture growth worldwide. Every dollar spent on non-essential consumption has an opportunity cost. That daily $5 coffee isn't just $5, it's potentially thousands lost in future compounded returns. Your spending habits directly dictate your wealth accumulation. Financial literacy isn't a one-time course, it's a lifelong commitment. The market evolves, tax laws change, and new investment vehicles emerge. Continuous learning, reading financial news, and adapting your strategy are non-negotiable for lasting success. Don't rely solely on your primary income. Cultivate multiple streams: a side hustle, rental property income, dividends from investments, or even royalties. Each additional stream reduces your dependence on a single source, building true financial resilience. Before aggressive investing, build a robust emergency fund. Aim for 3-6 months of living expenses in an easily accessible, high-yield savings account. This financial buffer protects you from unexpected job loss or medical emergencies, preventing forced asset sales. Finally, set clear, measurable financial goals. Whether it's a specific net worth by 40, early retirement by 55, or funding your children's college, concrete targets provide direction and motivation. Without a map, any road will do, but only one leads to wealth. Many believe some debt is good, especially for appreciating assets. Yet, even low-interest loans silently erode your future wealth, costing you thousands in lost investment opportunities. Think twice about carrying any debt. Lifestyle creep is the silent killer of wealth. As your income rises, so do your expenses: new car, bigger house, fancier gadgets. This psychological trap prevents you from accumulating significant capital, trapping you in a cycle. Every dollar spent on immediate gratification is a dollar not invested. That $5 daily coffee, compounded over 30 years at 8% returns, could be over $200,000. That's the power and the cost of opportunity. Not all debt is created equal. Good debt funds assets that appreciate, like a mortgage on a growing property or a loan for a profitable business. Bad debt finances depreciating items or consumption, like credit card balances. Taxes can silently drain your wealth. Are you maximizing your 401k or IRA contributions? Utilizing capital gains tax strategies? Smart tax efficiency can save you thousands annually, accelerating your path to financial freedom. Behavioral biases, like FOMO, fear of missing out, and attempting to time the market, lead to disaster. Investors often buy high when euphoria strikes and sell low during panic, missing out on S&P 500's consistent long-term growth. The myth of get rich quick is a dangerous illusion. While speculative investments promise quick gains, the real wealth is built through consistent, diversified, long-term investing. The S&P 500's average 10% annual return proves it. Dollar cost averaging is your secret weapon. By investing a fixed amount regularly, regardless of market fluctuations, you buy more shares when prices are low and fewer when high. This strategy smooths out volatility and builds wealth. Automation is key to consistent wealth building. Set up automatic transfers to your savings and investment accounts. This pay-yourself-first method removes emotional decisions and ensures your money works for you consistently. Diversification extends beyond stocks. Consider real estate for rental income and appreciation, or alternative investments like private equity or even certain commodities. A truly robust portfolio balances various asset classes for stability and growth. For complex financial landscapes, a fee-only fiduciary advisor can be invaluable. They legally prioritize your best interests, unlike commission-based agents. A good advisor helps tailor strategies, navigate taxes, and ensure your long-term plan stays on track. True wealth extends beyond your lifetime. Have you considered legacy planning? Estate planning ensures your hard-earned assets benefit future generations, securing your family's financial freedom and leaving a lasting impact. The ultimate break from the system is a mindset shift from consumer to owner. Prioritize acquiring assets that generate income or appreciate in value, rather than consuming depreciating liabilities. This transformation unlocks true financial freedom. This journey culminates in financial independence. Retire early: the FIRE movement. Imagine a life where your assets cover your living expenses, freeing you from traditional work. This isn't a dream, it's a meticulously planned reality. Your next step: review your current financial habits. Apply these principles to build a personalized wealth creation strategy. Start small, stay consistent, and remember, breaking free from the system is a marathon, not a sprint. True financial freedom isn't just about stacking cash, it's about fortifying your wealth so it works for you and the generations to come. Think of your assets as a fortress against the erosion of purchasing power, especially with inflation hovering around that 3.2% mark we saw in 2023. The biggest threat? Lifestyle creep. It's a systemic trap. As your paycheck grows, so does your overhead. Even with 401k balances surging 80% over the last decade, a staggering number of people are still living paycheck to paycheck under a mountain of stress. Don't let that be you. The market is a living, breathing beast. The same momentum that fueled the 400% NASDAQ run leading up to the dot-com era won't necessarily bail you out today. Sustainable wealth requires an obsession with continuous learning and the agility to pivot as global economics shift. You also can't do this in a vacuum. Surround yourself with a powerhouse network. Data shows that those with a strong financial community are 3 times more likely to hit their milestones. Remember, financial liberation isn't just a personal win, it's about leverage. It's the power to fund a visionary startup, back a cause you believe in, or create jobs. It's about having the capital to actually shape the world. This is a journey, not a finish line. Even once you hit your fire number, the game evolves. As Ray Dalio puts it, you must embrace the cycle of constant evolution. So here is your call to action: start today. Audit your expenses, automate your contributions, and master the tools of the trade like S&P 500 ETFs. Stop being a cog in the old system and start building your own. Your future self is counting on you to take the wheel. If this breakdown brought you value, drop a comment below, hit that subscribe button for Penny Pro, and turn on notifications. Let's get after it. See you in the next one.